Behold, ladies and gentlemen, for our first distinguished speaker of WES 2023, the internationally renowned current governor of the Banco de España, Dr. Pablo Hernández de Cos. Governor Hernández de Cos has tremendous experience within the world of finance in a great diversity of roles over his 2 decades at the Bank of Spain. Prior to his current position as governor, he was Director General for Economics, Statistics, and Research at the bank and headed its Economic Policy Analysis Division. Additionally, he mitigated the development of systemic risk and safeguarded Spain's sustainable macroeconomic growth as the Vice Chairman of the Board of the Spanish Macroprudential Authority Financial Stability Board. Along with his remarkable contributions to Spain, he has and continues to make his mark on global monetary policy, serving as chair of both the Basel Committee on Banking Supervision and of the Advisory Technical Committee of the European Systemic Risk Board. His involvement in numerous European and international committees speaks volumes. He holds a multitude of governing and advisory positions within the Bank of International Settlements, which is often described as the Bank for Central Banks, and is a prominent member for the Center of Latin American Monetary Studies. A key tenet of his term as the current governor of the Banco de España has been an emphasis on promoting price stability through periods of high uncertainty, most recently in the aftermath of the pandemic and during the ongoing Ukraine war. Today, we are privileged to get an inside look into policymaking through his varied macroeconomic insights from the real world. And I can think of few better qualified than Governor Hernández de Cos to speak on the need for fiscal rules in the context of EU member states. And ladies and gentlemen, a reminder that if you would like to ask questions at any point, please do so via the virtual platforms that we have, and they will be answered during the Q&A session at the end of a speech. So without further ado, please welcome Governor Pablo Hernández de Cos. Thank you very much. Thank you, sir. The stage is all yours.
Thank you very much. Splendid introduction. It will be very difficult to follow the excitement after this very good introduction. No, thank you first to the coordination team for the invitation. I should, in particular, thank you, the University of Warwick, and in particular, the Department of Economics, precisely for this type of event, for organizing this splendid summit, which, as you perfectly know, has benefited in the past from the works of highly distinguished participants since 2002. And of course, I'm very honored to now join this group of speakers. As our colleague was mentioning in the introduction, my intention today is to focus among the many topics that are currently relevant in the global and the European economy. I will focus on one of them, which is the key role of the fiscal governance framework of the European Union. What role this fiscal governance frameworks play and ought to play in the future. You may know that this fiscal governance framework is now subject to a significant debate. The European Commission has made a proposal to review, to modify, to adjust, to renovate this framework, and I want precisely to tackle on this. Before entering specifically on this topic, let me try to put it into the current economic context. The current economic context is one in which economic activity, even if more resilient than we were initially expecting, is losing steam. A series of factors, and of course, first and foremost, in the case of the euro area, the Russian invasion of Ukraine, are responsible for this adverse economic dynamics and, very importantly, for the surge of inflation to levels that we have not seen for decades. And this is the main reason why central banks across the globe, and in particular the European Central Bank in the euro area, have responded swiftly to the inflationary pressures, tightening financing conditions. Moreover, it's also important to emphasize that these shocks have thrown into stark relief European vulnerabilities in key areas, such or in particular in the energy sector, as well as the considerable disparities among countries in their relative exposures to these vulnerabilities. And this is why this context is related to the main focus of my talk, this is happening against the background of a significant increase in euro area public debt by almost 10 percentage points of GDP since the pandemic started, leading to high debt to GDP ratios and high structural to GDP ratios in several countries in the euro area that, to a great extent, have shrunk the available fiscal space and represent an important vulnerability for those economies that are observing these very high and public deficits. All these elements, in my view, underlie the importance of achieving the correct monetary and fiscal policy mix in order precisely to face the complex context that we are living. And in this regard, the current circumstances differ, and I think this is important also to be underlined, substantially from those prevailing at the outbreak of the COVID-19 pandemic. The pandemic confronted us with a severe, albeit temporary, exogenous shock, which was probably the biggest supply and demand shock we had faced in decades. And in that context, it was absolutely justified a coordinated and strong fiscal and monetary response precisely to try to support the incomes of both households and firms with the main objective to try to minimize the potential structural damage to employment, to productive capacity, and to economic growth caused by the crisis. And well, to a great extent, this significant response was made, both by the monetary authority, the ECB, and of course also by European authorities. However, the current context is different. In the current high inflation setting, the appropriate policy mix requires a tightening of monetary policies. This is exactly what we at the ECB are doing, and a fiscal stance that at the aggregate, at the euro area level, therefore, should not be at odds with this anti-inflationary stance. So in this regard, it's completely different to the situation during the pandemic. This means that government support measures should be temporary, should be targeted, and should be tailored to preserving incentives to consume less energy. In particular, measures should be gradually rolled back as energy prices fall. Otherwise, we are at risk of driving up medium-term inflationary pressures, which would call for a stronger monetary policy response. So I've underlined this several times in some of my latest speeches. We need a coherent response between monetary and fiscal policy. And in this regard, let me also stress that precisely achieving a fiscal stance that is consistent with the smooth operation of the European Monetary Union, while in parallel delivering sustainable public finance, is again precisely the role of the European Union's fiscal rules framework, or at least this should be its key aspiration. And this is the connection of today's events, the current economic context, with this topic that I wanted to tackle in this talk. So, why do we need fiscal rules? Let me be straightforward in stating upfront that a disciplined fiscal framework that fosters the sustainability of public finance is absolutely essential to guaranteeing macroeconomic stability and the proper functioning of the European Monetary Union. You may remember that under the Maastricht Treaty, the design of the European Monetary Union rested on basically two pillars: a single monetary policy authority and a set of coordinated national fiscal policies, which constituted the European Monetary Union's policy mix. The independent central bank, meaning the European Central Bank, targeting price stability, was entrusted with the responsibility for monetary policy. In turn, the stabilizing arm of the autonomous national fiscal policies was tasked with addressing idiosyncratic shocks and cyclical slippages while guaranteeing fiscal sustainability. The European Monetary Union was built also on the basis of placing full responsibility for fiscal policy decision-making and also implementation on the governments of the individual member states without, this is important, interfering with the conduct of monetary policy. And this is why in the treaty, the independence of the central bank was reinforced by the prohibition of monetary financing. At the same time, the consequences of fiscal actions were the sole responsibility of the individual member states. And this is again why a no bailout clause was included in the treaty. The main objective of this clause was that financial markets should play a disciplining role by requiring different risk premia according to underlying fiscal fundamentals. At the same time, limits were set on the deficit and on the public debt of member states that, as you perfectly know, were then developed by the so-called Stability and Growth Pact. There were two additional reasons for this introduction of fiscal rules. The first is that financial markets could not always be trusted to act as a deterrent against unsound policies, and the experience of the decade before the global financial crisis, I think it was a very good example of this statement. And then second, there could be situations where the no bailout clause might not be entirely credible, given that serious budgetary deviations in one country could generate economic and financial instability across the European Monetary Union as a whole, which would end up compelling the latter to bail out countries in difficulties. This is the reason why, from the very beginning, it was the intention to have these fiscal rules as a fundamental arm of the whole framework. In practice, the SGP, and you know this very well, implemented these principles through two values: 60% for the ratio of government to and 3% for the budget deficit to GDP ratio. And you also know that non-compliant countries enter what it is called the corrective arm of the Stability and Growth Pact, which ensure that excessive deficits were corrected in a given period of time. And compliant countries function under the preventive arm, which require convergence to the so-called medium-term budgetary policy objectives. So, with all the experience that we have had on this Stability and Growth Pact, one question that I think is absolutely fundamental is, well, to what extent we think that this fiscal governance framework has worked as intended, or in other words, whether there are shortcomings in this fiscal governance framework. And let me mention at least 5 points that I think are relevant and I think could be the basis, the initial thinking for a potential revision of this framework. First, the original rules set at the time of the Maastricht Treaty were overly simplistic and, for example, did not take into account the impact of the cyclical position on the budgets. And it's true that consecutive reforms attempted to address these shortcomings at the cost, it's also true, of increasing complexity. And specifically, you may know that the focus shifted to the use not so much of the budget deficit, but of the so-called structural deficit or the non-cyclical deficit. However, as you perfectly know as students of economics, this requires estimating the structural deficit requires, well, to estimate the cyclical position of the economy first, and also the elasticity of the cyclical position of the public finances to the cyclical position of the economy, which we know have proven to be notoriously difficult. And just let me give you one example of this difficulty. Evidence shows that in the case of the European Union, estimates of potential output and therefore of the output gap are revised up to 10 years after the first release. Okay, so estimating the cyclical part of the economy and therefore the cyclical position of budget deficits is really difficult in real time. Okay. Second point, while the current economic environment bears little resemblance to that of the 90s, the reference values that I was mentioning, the 60% for the debt-to-GDP ratio, the 3% for the deficit ratio, were included in the treaty as if they were structural permanent values of the economies. And of course, these limits were recalibrated on the basis of the average macroeconomic conditions at the end of the 90s. But economies, we know, are subject to structural transformations over time, and such limits should therefore be updated, or could, in principle, we might have the need to update these numbers. Third point, despite its focus on fiscal sustainability, the framework did not prevent a general and inconsistent increase in public debt. And again, experience shows that this is to a large extent due to a failure to comply with the rules, in particular in good times. Okay? So coming back to this concept of structural and cyclical deficit, of course, if the output gap, if the cyclical position is exuberant, if the output gap is positive, you should expect then not even to have a deficit, but to have a surplus. Okay? So we fail doing so. And by the way, this is not surprising because we know the literature emphasizes that it is the design of the fiscal rules and not so much their mere existence that determines why aspects such as the definition of the rule, the enforcement mechanism behind the rules, and the correction procedures are so important. 4 aspects to be mentioned. The initial design focused on fiscal imbalances, and exclusively on fiscal imbalances, overlooking the fact that other imbalances, such as financial or current account imbalances, are also important, are indeed very important for the correct functioning of the European Monetary Union. And as a result, it did not prevent the build-up of macroeconomic imbalances at the national level, which could potentially destabilize the euro area as a whole. And this was addressed during the euro area sovereign debt crisis with the introduction of the macroeconomic imbalance procedure, but we can today say that only to with a limited success. And fifth and final point, the treaty did not foresee the scale of the mechanisms needed for joint crisis management, including a common fiscal action to smooth the cycle and coordinate with a common monetary policy. And in fact, there was no crisis management mechanism in place until the creation of the so-called European Stability Mechanism in the wake, again, of the euro area sovereign debt crisis in 2012. In the aftermath of this crisis, this shortcoming again became evident in this crisis, I mean in the pandemic crisis, when the degree of fiscal policy coordination provided for in the fiscal framework fell short of the aggregate stimulus that was needed, the one that I was justifying at the beginning of the talk. Although, that said, we should commend the way in which the fiscal policy response during the pandemic learned from the past experiences. Temporary centralized fiscal instruments were put in place of very significant magnitude. You may remember the EU funds, for example, to complement precisely the activation of the SGP escape clause, which allowed for highly expansionary national fiscal policy stances. So during the pandemic, it was not only that national fiscal policies were very expansionary, but also there was an European response. Okay, and to a certain extent, this was able to confront the weakness of the framework itself. So, if we were to draw one lesson from this brief historical detour, it could be that beyond its foundational components, the fiscal governance framework embedded in the treaty has been continually adapted to a changing environment, and this is true, and significant headway has been made, particularly in times of crisis, and particularly during the sovereign debt crisis, but the successive reforms, in my view, have not addressed all of the pending issues. And if you want to put this more structural statement that I just made with the current context, you have also to take into account, as I said at the beginning, that the huge need for fiscal support during the pandemic forced the suspension of the fiscal framework and led to a significant increase in the level of public debt, greatly reducing the fiscal space against a background also, and this is important, of pressing long-term public investment needs, in particular, as you perfectly know, in the fields of digitalization or in the fields of climate change. In this context, high inflation and the shift towards a restrictive monetary policy might encourage financial markets to pay more attention to debt sustainability concerns. So, all in all, and in a nutshell, in my view, a credible fiscal framework is today more important than ever. So, this is, I think, is also the position of the European Commission, the European Council, and this is why the European Commission is currently undertaking a review of the European Union's fiscal framework. And what are the aims that the European Commission has put in this review? Well, the aim is reducing the complexity of the current framework. The aim is also to improve compliance. The aim is to try to promote a more counter-cyclical fiscal policy, and also to accommodate the new investment needs of the green and digital transformations that I've just mentioned. So let me now spend a few minutes describing very briefly the main features of the European Commission proposal, so that I can later share with you my own views on the key aspects a functioning fiscal framework should have. So first point of the European Commission proposal is the main objective of the proposal is to ensure that public debt ratios are put on a downward path. Okay, that's the key element of the proposal. Keeping, of course, the debt to GDP ratio of 60% as a reference, and in parallel, also retaining the need for public deficits to stay below the 3% reference value over the medium term, which, I mean, there is already some evidence that this reference has proven to be effective in anchoring member states' public accounts. That's the first element of the proposal. Second element, in order precisely to meet this objective, member states should present medium-term fiscal structural plans that ensure that the debt ratio is kept or brought into a sustainable path by the end of a certain adjustment period, okay? And the adjustment period will be discussed and agreed upon bilaterally with the European Commission before being adopted by the European Council. Third point, these medium-term structural plans will incorporate public investment and also structural reform commitments by member states, okay? And in principle, there is even the possibility that there being a longer fiscal adjustment period or a more gradual adjustment. So there is a link of the adjustment period and, as a kind of incentive, governments to put in place investment programs or structural reforms that could lead to a longer adjustment period. Okay, this is trying to play a bit as an incentive mechanism, as I was saying. Fourth element, and final element, there are many other details, but I will focus only on these four elements. The fiscal adjustment path is to be based on a long-term fiscal sustainability anchor. Okay, there will be an analysis of fiscal sustainability of each member state. And implemented, once this has been said, it will be implemented through a single and simple expenditure rule. Okay, we will forget, therefore, of this concept of structural and cyclical deficits. Okay, we will have this debt sustainability analysis that will be the anchor in order to fix and to have these medium-term fiscal plans. And once that it has been approved, the implementation of them will be through an expenditure rule. Okay. Well, these are the main elements of the European Commission proposal. So, which are my views of this proposal? Well, I think these orientations are a promising starting point for a debate that should, as I was saying at the beginning, by the end of the year, lead to the adoption of an improved fiscal and governance framework. In particular, I can even say that the proposal reflects the consensus that has been reached in the last decade both theoretical and empirical literature on how fiscal rules should be designed. Okay, and there are at least 4 elements that are covering, that are taken from this literature. First, this anchor on debt sustainability and putting debt sustainability at the center of the debate. Okay. Second, the fact that the proposal highlights the need to use an expenditure rule as an intermediate target. Given why this is important? Well, basically because expenditure is the main variable that is under the control of fiscal authorities, and it allows, when you fix an expenditure fiscal rule, you basically also allow for extraordinary public revenues that may emerge, and sometimes they emerge, to be safe. Okay. Third element that it is important is that the focus on debt sustainability makes it possible to include previously missing elements, specifically the macroeconomic environment, the potential growth, and the natural interest rate concept. Of course, probably you've already studied in your economic courses. If you try to analyze debt sustainability, of course, the fiscal variables are absolutely crucial, but also the interest rate assumptions or the growth assumptions in the long run are even or equally relevant. Okay, and this is why incorporating this concept of the sustainability is compatible, let's say, with the current economic literature on this domain. And finally, and the 4th element that I want also to stress that is important is that the proposal allows for greater cross-country heterogeneity in the targets and therefore for heterogeneous design of fiscal consolidation. Having said that, let me try to elaborate a little more on these elements and try to mention some elements that perhaps are, not some nuances around the proposal. The first one is that, of course, it should be taken into account the economic transformations that have been taking place over recent decades, in particular the sharp increase in debt ratios, but also potential decline of the natural interest rates, or also the potential decline on potential output growth of our economies. That's, of course, important. At the same time, I think it's also important to emphasize that the new rules need to accommodate a greater degree, and by taking all these variables together, that would be a good outcome. However, and in any event, let me also say that the devil is in the details. While this is in principle desirable, the key aspect is how the deadlines for the necessary fiscal adjustment are calibrated. And here, let me emphasize the credibility of the fiscal framework could be endangered if the deadlines are too lengthy, or if the fiscal adjustment is backloaded. Okay, for the credibility of the framework, of the new framework, I think this is relevant. Second element, or second nuance, the fiscal rules must be able to avoid the traditional pro-cyclical behavior of public finances. Ideally, fiscal rules should foster savings during expansions and support growth during recessions. It would be, therefore, desirable for the new framework to incorporate a clear incentive scheme to boost efforts to consolidate public finances while the economy is doing well, so as to provide room for maneuver in times of crisis. And in this regard, a combination of positive incentives, such as, for example, allowing countries to design the fiscal consolidation path, and negative incentives as well, for example, an improved regime of sanctions, including restrictions on the access to EU funds, could be a good combination of incentive mechanisms. Third nuance, greater compliance can be achieved with rules that are more automatic. And the Commission's proposals improves automaticity to some degree, but the effective application remains to be seen. We need to remain particularly vigilant on these factors which have contributed to the failure of past reforms. And in this case, let me perhaps emphasize one point, which is that an enhanced role for independent fiscal authorities, most, if not all, European Union countries have already set independent fiscal authorities, including, of course, Spain, and the history and practice have shown that well-designed independent fiscal councils can enhance the accuracy of fiscal forecasts and improve compliance with fiscal rules. Therefore, the reform should encourage the strengthening of independent fiscal institutions with the final objective of giving them a formal role on the assessment of compliance with the fiscal framework. For nuance, another key aspect is simplicity. I was mentioning this issue before, while of course at the same time preserving a sense of realism. An overly complex and non-transparent framework hinders the effectiveness of the rules. And in this sense, the reform proposal by the Commission is based on this concept of debt sustainability analysis framework. Yet, we know the concept of the sustainability is not easy to operationalize. And indeed, the practical application of the concept of the sustainability for informing policy decisions remains rather complex. In this sense, it is worth remembering that any framework aimed at providing the necessary adjustment to cyclical developments must rely on the use of unabsorbable variables. In the case of the sustainability analysis, it will be necessary to forecast medium-term nominal GDP growth, which will face problems which are not very different. Indeed, they are very similar to the measurement of the structural deficit. And in this regard, it seems that we may be shifting complexity away from the rule framework and moving it towards the analysis of the sustainability. Okay, and then fifth point, the reform proposal also addresses the possibility of redirecting additional public funds towards the climate and digital targets through the use of an extended period of adjustment. I was mentioning this before. I believe this approach is better than the use of the so-called golden rules to finance green investment, which allow governments to exclude some types of expenditure from the calculation of the fiscal targets. And this is my belief for several reasons. These rules, the golden rules, would add complexity to an already, as I was emphasizing before, very complex system, would require negotiating and monitoring the list of expenditure items to be excluded, and would have to be implemented without endangering fiscal sustainability. However, let me also emphasize that the challenges of the green and digital transitions exceed by far the fiscal space of national governments today. And this is why I think a more efficient option would be to set up a common European financing instrument covering the investment needs to meet common objectives, such as reaching net zero emissions and combating climate change. And then my final point is that the European Commission's orientation misses, in my view, an element that I firmly believe is essential for the success of any reform of the fiscal governance framework. I cannot conceive of a new EU fiscal rule framework without reforming the rest of the European Union's economic and financial governance architecture. This would entail, for instance, establishing a European unemployment insurance system and central fiscal capacity. And this should also mean to include the completion of the banking union and the creation of a capital market unions, which are absolutely fundamental for the function of the European Monetary Union. So let me conclude. I've tried to convey to you the idea that the European Union's fiscal governance framework is a key element of our institutional architecture. A second message is, of course, that there is broad consensus about this, that there is a need for this for the current fiscal framework to be reformed. Third idea is that the European Union's Commission orientations and the lively debate among academics and other policymakers will offer surely new and ambitious proposals to move forward, including, most importantly, broadening the scope to progress further with the European Monetary Union. And it is my belief that this debate will lead to a better functioning economic governance framework to the European Union. To quote your university's motto, mens agitat molem. Let's hope that this is the case. Thank you very much.
Thank you, Governor Hernández for your insightful speech, indicative of your sterling experience within the field of macroeconomic policymaking. On that note, we will transition into our Q&A session with the first in-person question from the audience. Governor, please take a seat. Yes, person in the front.
Hey, how you doing? Alonso with Bloomberg. Just a couple of questions for you, Governor, on talking about fiscal, the importance of the fiscal balance. I'm wondering, how do you rate the current fiscal stance of the Eurozone at this moment? And a couple of other questions on monetary policy that I have to ask you. When do you expect underlying inflation to reach its peak? And how will that influence the next monetary steps? And also, are you happy with the current market pricing of terminal rate of about 3.5%?
Thank you very much. I should tell you that Alonso is not a student anymore. Okay. No, on the fiscal stance, well, I think it's important to decompose or try to question in two parts. The first one is, true from a purely aggregate point of view. The fiscal stance and measured, for example, by the change in the structural deficit of the euro area countries in aggregate terms might be neutral or slightly expansionary. Okay, but I think it's the second part of the question that is more relevant. I mean, I was emphasizing in my presentation that the current context, differently for sure to the context that we lived during the pandemic, there is a need for a fiscal policy action, but this should be completely different to the one that was done and was justified during the pandemic, mainly because we are confronted with an inflation spike, a very significant inflation spike, and also because the origin of the shock, the fact that there is an energy component, of course, this is also completely different to the pandemic. Okay, and this is why we are justifying, yes, a certain role for fiscal policy to play, but this should be focused and limited to try to preserve the real economic incomes of the most vulnerable people. Okay, and this means we are advocating for very much targeted fiscal response. And in this regard, well, the assessment that the European Commission has made, which is very similar, by the way, to the one that we are currently doing, probably the conclusion is that the fiscal response is not sufficiently targeted. In principle, most of the measures have been defined as temporary, which is also good. It's something that we are also advocating, but it is not sufficiently targeted. And I think this is important because, as I was saying, of course, the coherence between fiscal and monetary policy in this particular moment is very, very important. If in the end we end with a fiscal policy that it is too expansionary and too broad, then this would mean that inflationary process would emerge, apart from those that we have already observed, and therefore the reaction of monetary policy should be higher, okay, as compared to the counterfactual. Then on inflation, well, as you know, the last forecast of the staff of the Eurosystem was published in December. It was a significant revision of upward revision of the inflation path for the period 2022-2024. A new year was added to the inflation horizon, which is 2025. Well, the fact in particular that in 2025 inflation, the projected inflation numbers were above the target of the European Central Bank, which is this medium run, well, caused a reaction by the Governing Council in December. And there was, of course, the decision taken last week by the Governing Council was compatible also with the communication that had been taken previously in December. So now, and also trying to answer the second part of the question on monetary policy, I think what it is important is to wait for the March forecast. The staff will provide us with a complete forecast incorporating all the market reactions after our decisions in December and February. They will also, of course, incorporate all the new data that has been published on wages, on markups, on headline inflation, on the composition of inflation. And we thought already indicated our intention to increase rates by 50 basis points in March. But with all this information, we will analyze all this information and we will then communicate what the consequences of this new information are in terms of the future of monetary policy. And this is what I want to say at this moment. For me, all options after March are open. We have to analyze all the data, and in particular the forecast that will be done by the staff.
Thank you so much, Governor, for that answer. We do have another in-person question from the man in the blue jacket.
Hi there. Thank you for a very interesting talk, especially with insight on the European framework and fiscal policy side of things. We have many questions on this, but we need to first prioritize Mark Jones from Reuters. He's joined us virtually and he has a couple of questions for us. For time's sake, I'll ask the first one and see how we do. So his first main question is, are the financial markets reading the ECB signals right at the moment? Or do you think the cycle of rate increases could go on longer than currently expected?
Well, again, this is very much related to the question that was raised by Alonso. I mean, what I'm confident is that the markets interpreted well our decision and our communication in March, in the sense that, again, the staff provided us with a forecast that didn't guarantee, under the assumptions of the market, the interest rate assumptions that were made before that meeting, didn't provide us with confidence of reaching our 2% target in the medium run. And this is why we communicated the way we communicated in December, and we acted and communicated the way we did in February. But of course, since then, the market has reacted, moving upwards the interest rate path and moving also the terminal rate of that we might end. Of course, I don't want to validate completely these expectations, but the direction on which the market reacted is, of course, very much fine with the way we wanted it to be moved. And again, whether in the end the current expectations of the markets are the correct ones, I think we will be in a better position to analyze and to be more precise in March, when the forecast of the staff will be produced, will be presented to the Governing Council, and based on this forecast, we will act and communicate.
With that perceptive answer, we unfortunately have to bring this Q&A session to a close. Thank you to Governor Hernández and to our audience for your engaging contributions.